Current ratio. This is basically a part of a bigger group liquidity ratio. So liquidity ratio contains majorly current ratio, quick ratio and cash ratio. So what are the topics covered in this video? This video will cover basic formula, how to calculate it, how to interpret it, what is a practical example, what is the preferable range, and how to take a decision basis this ratio. Let's talk about all these topics one by one. Current ratio formula. This formula is very easy. You need to take current assets and divide it by current liabilities. If you have $2 of current assets and $100 of current liabilities, it would be very simple. Divide 200 by 100 and the ratio would be 2 is to 1 or 2 times. Okay. Now you need two basic things for to calculate this ratio. Current assets and current liabilities. What are these items? If we talk about an organization, current assets are those assets which an organization is expecting to realize within the next 1 year or its operating cycle. Similarly, current liabilities are those liabilities which an organization is expecting to pay off within 1 year or its operating cycle. So let's take some general examples what are included in a current assets and current liabilities. So current assets typically might include cash, marketable investments, account receivable, inventory. On the other hand, current liabilities might include accounts payable, taxes payable, short-term loans, and accrued expenses. Now we know that what are the current assets and what are the current liabilities. It's very easy to calculate our ratio. Now we have calculated the ratio. The next point is how to interpret it. If I am saying that ratio is 2 is to 1 or 2 times, how to interpret it? It will be interpreted in such a way that we have to pay $1 of current liabilities, we have $2 of current assets with us to cover. To pay off every $1 of current liabilities, we have $2 of current assets with us to pay off. Okay. Do you like drinking Coke and Pepsi? Let's calculate their ratio. Coke. Current assets of Coke are 30k. Current liabilities of Coke are 29k. We calculate the ratio 30 divided by 29. It is around 1.05. Now it's turn of Pepsi. Current assets are 21k. Current liabilities are 22k. The ratio would be 21 divided by 22, 0.99. In this way, you can calculate any organization's current ratio. You need to simply extract the financial information of these companies from their website or stock exchange website. Okay. What is the acceptable range for current ratio? Generally, 2 is to 1 is considered as the most acceptable range of current ratio. Now, what if your current ratio is lesser than 2 or very lesser than, let's say, 0.8? So it will not be considered as a healthy. Because to pay off $1 of current liabilities, you just have $0.8 of current assets. So it is not a good liquid situation. Okay. So what if your current asset ratio is very high? Let's say 5 is to 1. Now you can easily pay off your current liabilities, but it might indicate extra assets. It might indicate inefficient use of resources. So current ratio must be near to your acceptable range or benchmark range, not very higher and not very lower. Okay, so is this 2 is to ratio 2 ratio 1 must be considered as a benchmark for every company? No, this is a generic benchmark which is given in the books. In practically, if you talk about practically, let's say you are a steel company, you might compare your current ratio with an industry average. There must be industry of steel industry and metal industry. So you can take industry average current ratio as a benchmark to compare your own current ratio. This is how practically happens. A lot of users of financial informations compare the company's ratios, may it be current ratio or maybe any other ratio, with the industry average ratios to look out whether the company's health is in the good situation or not. This is practically what happens. So you may consider industry average as a benchmark. Okay. Let's consider an example of decision making on the basis of this current ratio. Let's say there are creditors and short-term lenders. You know that creditors and the short-term loan make part of current liabilities. So let's say there are two companies, company A and company B. Company A has current ratio of 1.9. Company B has a current ratio of 1.2. Let's assume that the company A and company B are same in all other respects except this current ratio. They have same business, same capital structure, same potential, every other thing is same except this current ratio. Now tell me whose company they should go for their credit or their loan. Which company? Obviously the answer is company A. Why? Because company A has more current assets to repay their current liabilities, their loan, their credit. That's why they should go for company A, because company A has a higher ratio in comparative to company B. That's how decision making is done. That's how this current ratio helps in making decision. Thank you.
Your love and support motivate us to keep videos posted on the channel. So subscribe the channel to motivate us. And after you subscribe, press the bell icon so that you get notification of our next videos. Share this video if you want other to learn from this concept. And like the video if you really like it. Thank you. Thank you for learning concepts from channel Concepts for You.